Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. With mounting pressure amid sluggish forecasts for Korea's economic growth rate this year, all eyes are now on the Bank of Korea's upcoming Monetary Policy Committee meeting, set to be held on February 25th. Experts anticipate a rate cut from the current 3% to 2.75%, a decision that follows recent moves to lower rates in October and November after a period of stability last month. The Bank of Korea's chief has also signaled a downward revision of the nation's growth outlook, reducing the forecast from 1.9% to about 1.6%. Should these adjustments materialize, this year will mark the first time Korea's annual growth rate drops below the 2% threshold. For further insights into these developments, we connect to Kim Mok-yeon, professor at Seogang Business School. Welcome, Professor Kim.
Good evening.
And also joining us is Choi Sang-mi, professor of business administration at Ewha Women's University. Great to have you with us, Professor.
Good evening.
Now, let's start with Professor Kim. So like I've said, the BOK's Monetary Policy Committee will decide the February benchmark interest rate tomorrow, that is. The focus seems to be on interest rate cuts to stimulate domestic demand. What's your personal forecast?
Well, my personal forecast is kind of minority group. Before giving my own thought about the rate cut, I would like to introduce two polls, where most market experts agree to the base interest cut by 25 basis points. Now the first poll is conducted by Yonhap Infomax, the financial news arm of Yonhap News Agency, which indicated that 20 out of 21 local analysts and expert polled predicted the Bank of Korea will cut its base rate to 2.75% from the current 3% at its tomorrow rate setting meeting. And the other poll is the one conducted by the Korea Financial Investment Association on 100 bond experts, in that 55% expected the BOK to slash the policy rate by 25 base point in the tomorrow meeting, while 45% responded, the central bank is projected to freeze the rate. The key reasons of the rate cut expectations are, firstly, the BOK Governor Ri Chang-yong has hinted at slashing the economic outlook to around 1.6%, like you mentioned, from its previous forecast of a 1.9% expansion, which is below Korea's potential growth rate of 2%. Secondly, the foreign exchange rate looks being stabilized at the moment at 1,421 per dollar. Thirdly, Korea is, facing growing downside risk centering on weak domestic demand. I agree to the reasons that experts said. However, my personal opinion is the Monetary Policy Committee will freeze the rate at 3% once more. I think they need to check other situations like the inflation rate in Korea and the U.S., which is a big concern now. The prices in the housing market after the Seoul mayor lifted the ban for the purchase in the land transaction permission areas in Seoul. Most importantly, the dollar index is 106, which is still very high. Based on this analysis, I expect the base rate, maybe on hold at 3% this time. One more, but I wish I'm wrong this time about my prediction.
Right, but we'll still have to see. We really don't know as of now, but it will be crucial to see whether the BOK prioritizes growth support or financial stability in its decision.
Right.
Now also to Professor Choi, exchange rate volatility, like Professor Kim has mentioned, is a key factor in deciding the benchmark interest rate. Can we say that the focus on an interest rate cut in the February meeting is because of the volatility of the Korean won-US dollar exchange that had somewhat stabilized? What's the current situation in the exchange market?
Actually, not exactly. The exchange rate is important, but the main reason for the expected rate cut is not because of the exchange rate has stabilized. In fact, I think the Korean won is still under pressure to weaken, especially if the Bank of Korea lowers interest rate again. So think of it this way. When the interest rate go down, then it makes the Korean won less attractive for investor, which can lead to a weaker currency. The ING, the Global Investment Bank, expect the Korean won USD exchange rate to fluctuate between 1,375 and 1,475 Korean won per USD, which is a wider range than before. This means there's still a lot of uncertainty. Right now, the Bank of Korea is focusing more on helping the economy grow, even if that means the Korean won may lose some value in the process.
Right, so there's a lot of other factors that are in play. Now, a low domestic economic growth forecast is also cited as a factor for the expected interest rate cut, and domestic and international organizations are predicting Korea's growth rate will be in the 1% range this year. Professor Kim, what do you think is the biggest downside risk to the economy right now?
Yeah, I mean, Professor Che explained very well, the downside risk of, Korean economy might be the most important concern of the BOKs when they decide the base rate cut. So, as I mentioned earlier, the BOK Governor Ri Chang-yong mentioned the economic growth rate of Korea this year would be around 1.6%, which is far below Korea's potential growth rate of 2%. According to the International Monetary Fund, which assessed that the downward risk of the Korean economy is strong, the prolonged political uncertainty would adversely affect investment and consumer sentiment and increase financial volatility. In the sense, the biggest downside risk will be the political uncertainty caused by the martial law declaration by the President Yoon. The second biggest risk will be the trade policy of Trump administration. Mr. Trump is using the tariff to negotiate with the trading partners to get the best out of it. The goal of the new U.S. trade policy looks very clear: to make trade partners weak, to give competitive advantage to the U.S. industries and companies. But it is causing lots of uncertainty to the trade partner countries as well as companies in the ways of dealing with that tariff policy. In particular, at the moment when Korean government lost the power of controlling the situation, it is imposing big risk on Korean companies. Finally, Chinese oversupply will continue to be the threat to Korean economy. The Korean companies need to fight fiercely with Chinese companies, including like big platforms like Alibaba and Temu across the world, except the U.S. There is no gap between Korean and Chinese companies and industries in terms of technology and product quality at the moment. The Korean companies need to differentiate their product and services from the Chinese competitors if they want is successfully compete in the world.
Right. So the most significant risk would be political uncertainty, shifting U.S. trade policies, and China's growing dominance. Right. So all these combined would definitely add complexity to the economic outlook. Now, as we were speaking, the Bank of Korea is expected to announce its revised economic forecast along with the interest rate decision. And it has, like we've said, previously forecasted the growth rate to be 1.9% this year. Professor Che, how would you expect the BOK's economic growth forecast to be revised as?
I think the growth forecast will be lowered because of economy is slowing down, as you know. Let's put it into perspective, like ING, that projects the Korean's economy will grow by only 1.6% in 2025, compared to 2.2% last year. So this slowdown is mainly because Korea's exports are weak and people are spending less money. even though the lower interest rate can help by making loans cheaper, it won't fix all the problem. So businesses are still cautious about investing, and global trade is uncertain. If the governments introduce a supplementary budget, which is extra spending to support the economy, but it might help boost growth. However, if external demands for Korean products remains weak, growth could still stay low. That's why the Bank of Korea may lower its growth forecast to around like 1.7 to 1.8%.
Now, also, Professor Che, if the BOK cuts the interest rate, the current 1.5% point gap between South Korea and the U.S. will widen. Could you explain for us the impact? What kind of impact will the widening of the interest rate gap between the two countries have on the financial markets?
Actually, if Korea's lowers interest rate, but the U.S. keeps them high, so then there is a wider gap between the two countries. Investors might take their money out of Korea and put it into U.S. asset instead, leading to a weaker Korean won and possible capital outflow. That could be a big problem. Yeah.
Mm-hmm. Now, on the other hand, considering the U.S. Fed's pace of interest rate cuts and the record high household debt from last year, some analysts believe that a freeze cannot be entirely ruled out. What are your thoughts on this, Professor Kim?
Yeah, as I already mentioned, the possibility of a freeze at 3% point, 3% of the base interest rate cannot be ruled out. Now, the reason the BOK governor asked Korean government to form a supplementary budget to support the sluggish domestic consumption and investment is from the worries about the record high household debt and recently rising consumer and producer prices and the volatility in the foreign exchange rate, even though it looks like stabilized. I believe that he's thinking rather than using monetary policy, deploying fiscal policy, including the supplementary budget, will be more effective to boost up domestic consumption and investment. I entirely echo to his idea. Moreover, the U.S. Fed is expected to keep its position like hawkish about the interest rate, or even tighten its policy by raising the rate due to its strong economy. If it happens, we won't have any tools to address the changes in the U.S. Fed policy after we cut the rate at this time.
Right, so you have been stressing that there are high chances of a rate freeze this time around, but we'll still have to wait. But if we do assume for a potential interest rate cut in February, Professor Kim, when could we expect the next rate cut? And also, what's your forecast for the final interest rate by the end of the year?
Yeah, most experts expected the next interest cut will come in May, if we have that interest cut tomorrow. So basically, if the economy continues sluggish, the BOK need to cut the base rate a couple of times in this year, which will end up with 2.5%, to my understanding. So my prediction is coming from the idea that this time the BOK may hold the rate, and at the next meeting, they cut the rate once, that is 2.5, right? Or this time they cut 25 base point, and probably meeting in September, they may cut the rate once more. Then that'll make it like 2.5%. Like everybody knows, the BOK decision on the base interest rate won't be independently made. According to the U.S. Fed dot plot, which is a chart that aggregate the interest rate forecast of Fed commissioners, the year-end interest rate forecast will be 3.9%. That raised from 3.4% earlier. If the BOK will keep the gap between the U.S. and Korean base interest rate same at 1.5%, it cannot go down below 2.5%. So I think, at the year end, we may see 2.5% of interest rate.
Right. So if the BOK holds this time, they may have to cut rates later to support growth. Of course,
Right.
external factors must be considered. Now, we have touched upon this a while ago, but circling back to the topic, in order to stimulate the economy, both businesses and political sectors agree on the need for a supplementary budget. But there are differences in the scale and timing of it. Professor Che, what are your views on the necessary scale and timing of the supplementary budget?
Junior supplementary budget can be very important, especially when the economy is slowing down. It works like a financial boost from government to help business and consumers. So if you ask how big it should be, I would just say to make a real difference, the budget should be at least 1% of Korea's GDP. That means spending a lot of money on infrastructure projects, tax cuts for businesses and social program to encourage people to spend more. And regarding the second question, when should it be introduced? I would say the sooner the better. If governments wait too long, for example, until the second half of this year, the economy might slow down even more, and the impact of the budget would be weaker, I think. So the best time would be the first half of this year, Q1 or Q2. However, there is a problem, as you know, the politicians disagree on how much money should be spent and where it should go. And if they take too long to decide, the Bank of Korea will have to rely more on interest rate cuts, which is not a long-term solution, as you know. So the key takeaway is that both monetary policy and the fiscal policy need to work together to support the economy.
Right. What about on Professor Kim? Are you on the same page with Professor Che in terms of the supplementary scale?
Yeah, I mean, we need, the supplementary budget as soon as possible. But, the thing is, political situation won't allow those kind of early decisions. So at least, right after the new government comes and then come in, and then we need to have that supplementary budget. And the amount, probably there would be like a 20 trillion Korean won or to 30 trillion Korean won would be like at the best, like the BOK governor, Lee Chang-yong mentioned.
So we are on the same page that it is really necessary for the current situation. Now, meanwhile, regarding one of the downside risks to the economy, the Trump-era tariff policy, of course, last week, Deputy Minister Park Jong-won from the Ministry of Trade, Industry and Energy, along with some private economic delegation, went to the U.S. to engage in diplomatic efforts. Professor Kim, what negotiation strategies would you recommend to be prepared for the future?
First of all, at the moment, Korean government would not have much power, on dealing with those kind of tariff issues. There's, government people and the private sectors, go together, delegate, our country to the United States, a new government. That's very good. I mean, they do, excellent job. I like to, talk about that first. And to come up with, solutions to deal with the Trump administration, we need to understand what he wants to do with the tariff policy, right? His goal is very, very clear. His goal of imposing tariff on imported goods looks, very clear, considering the amount of the trade deficit the U.S. is experiencing, which is over $1.2 trillion. He looks to make the U.S. manufacturing industry strong again by asking companies which export to sell their product in the U.S. to build factories in the U.S. He also looks to use the tariff to achieve a specific agenda in the relationship with other countries like Mexico, Canada, and EU and China, whatever the country which export their products, services to the U.S. So we may have to have the list of collaboration with the U.S. and U.S. companies from like shipbuilding, manufacturing technologies, in defense technologies, and sometimes defense cost sharing too. we can use those kind of items as a leverage in the negotiation with Trump administration, because Trump do not think allies or alliance important, right? Everything he want to use negotiate to get his own purpose. So we have to understand that very nature of Mr. Trump, the negotiation strategy. So we have to adapt to that strategies, quickly.
Right, so we have to keep in mind what he really wants. So it seems navigating U.S. trade policy under the Trump administration will be a critical challenge for Korea, which requires strategic negotiation and also economic diplomacy as well. We'll continue to follow these developments closely and bring you these latest analysis. We'll have to wrap up our discussion right here. Professor Kim, thank you so much for your insights.
Thanks for having me.
And Professor Che, of course, thank you so much for spending time with us tonight.
Thank you.
And that'll be all from us, all within the frame. Be sure to tune in next time as we continue to explore the stories that matter. Until then, stay informed and engaged.